All right, what's up traders? What's up tycoons? Super excited for today's video. Really super important one. I tried to record it early this morning, but something happened with the upload. And so we are going to be going over this in today's video, going down TLT. All right, we're going to take a look at the daily chart structure. All right, we're going to take a look at the weekly chart structure. There's lots of warning signs in TLT right now. We'll zoom in on the daily chart so that you guys can see things a little bit more clearly. All right, now, just because there's warning signs doesn't mean it's all over for bonds. After the Fed's final policy rate hike, bonds tend to reward. I'm really interested in bond funds right now, but, I'm not going long for the long term just quite yet. Still waiting a little bit. We'll dive into that some more. All right, now, SPY had an island bottom reversal. We saw a huge blast off today. We pretty much crushed it in the Discord today. Many plays up over 100%. If we take a look and dive a little bit more, all right, we can see that we also had an abandoned baby pattern forming here on the SPY daily time frame. This one right here was the 5-minute, I believe. Lots of setups in here. Now, what could cause the market to push higher than expected in the coming weeks and months? We'll go over that, break things down for you guys so you can really understand. And we're going to take a look here. And, people forget that the stock market is mostly positive, okay? If you look at the historical data of how often the stock market is positive, it's pretty interesting. We'll really dive into that because a lot of people are really wondering, how things are so positive right now, especially after such a bearish 2022 and such a bear market. We're also going to take a look at the cumulative capital flow to equities and, the total money market fund assets. Okay, there's still some warning signs. Okay, my last video that I dropped, okay, on this subject, there are lots of warning signs that we're seeing across the market. So it has been a little bit difficult to trade the market because there's lots of warning signs, but things continue to still go up. We'll go over some of the warning signs again, some different ones in today's video. And we can see here that the probabilities for a rate hike is actually going up substantially, right? It's basically at 40% right now. We take a look at the financial conditions versus the stock market, right? And really just dive into some of the reasons why the probability is increasing higher, okay? This will be a good chart. We'll break that down. And also the core sticky inflation versus the Fed fund rate. Some really good charts to help explain some of the macro things going on. Now, full disclosure, the content provided on this channel is for informational and educational purposes only. It's not intended to be relied upon as legal, financial, or investment advice. Trading in stocks, bonds, commodities, and crypto involves a significant risk of loss and is not suitable for all investors. Let's jump into it. Now, all of these charts are dated May 25th, okay? I know it's the 26th right now, but as I mentioned, I was trying to upload this early in the morning and we had some problems there. So keep that in mind. But initially on TLT, I remember when I first started covering it on YouTube and I was telling people, we were looking to get some, targeting basically $90 to $80 on TLT roughly. And a lot of people were saying that that was insane. That's crazy. We still may not get down to there, but initially we were tracking a 5-wave move to the downside, right? A 1, 2, 3, 4, 5. And then we broke that structure, right? And if you take a look here, TLT has essentially been in a range since, December of last year. So for the past 6 months, TLT has really gone nowhere and has just been going up and down, up and down, up and down, which I really don't mind. It's provided some really amazing trading opportunities. We'll dive into those opportunities a little bit more, but there's lots of warning signs on TLT. I was going to tell you guys earlier this morning that TLT most likely is going to bounce. There's a double bottom. We did get a bounce today. TLT is up a little bit. If we zoom in or if we go to the weekly chart, right? Remember, we were targeting that 5-wave structure to take us down to about $87 to $81. We have a bear pennant forming right now on the weekly chart, right? So, and the target for that, look at exactly where that's going to take you, right up there to $81. So, if this structure and if this pattern is going to play out, we could see a move all the way down to $81 on TLT. So, why would this happen, right? Why are things like this happening? Well, as we saw earlier, we are seeing higher probabilities for another rate hike. As interest rates go up, the treasury rates are going to go up, and that's going to cause the prices of bonds to go down. Also, we have the debt ceiling debate, and there's a lot of pricing in that Yellen is going to flood the treasury market, okay? And, if that happens, that's going to also cause the prices of bond funds to go down, such as TLT. So, from a technical standpoint, we're seeing, breakdowns, we're seeing signals. And then from, a macro and more fundamental standpoint, we are seeing warning signs and signals there as well that bonds could continue to head lower. Will it play out perfectly and go down to, $80, $90? We can't tell the future, but we can just try to help, analyze the data that we have in front of us. Remember, candlesticks are nothing but live data that you guys are able to read and see. It's basically just an auction, right, between buyers and sellers. Now, besides the pattern, we also have signal here on the MACD. We see the MACD curling down below this red line here. That is typically known as an exit signal when it curls down below the yellow line. All right, if you take a look here, we had a huge exit signal, okay, back in the beginning of 2022, and that's when TLT had a huge, massive drop from, the 150s all the way down to, the high 90s, right? Now, we need to be cautious of it doing something like this, okay, and just dipping down below and then curling back up above. That's what happened over here, and we got a false sell signal, and you can see we actually ended up curling back up ultimately before getting the real sell signal where we had a huge sell-off. So, it's not fully confirmed that, we're about to start some big sell-off on TLT, but when you look at the MACD, the weekly MACD crossing over to the downside, and then you combine that with the bear pennant right here on the weekly chart, things do look like we are heading for a move lower in TLT. Right. If we zoom in on the daily time frame, it's been something really, really honestly amazing to trade, right? I've been killing it and crushing it with TLT option trades. Again, we look at the MACD, we have entry signals here where the red line crosses up above, see a huge move up, right? Exit signal here when the red line crosses down below, huge move down over here, crosses back up above, so on and so forth. There's been many, many signals, and we were looking to see what the MACD was going to do here recently. Was it going to curl back up and bounce off of this trend line here and potentially give us an entry signal? Rather, we rejected the yellow line and we're continuing to head lower. We also broke our bullish divergence trend line, which has been a really important trend line on the RSI. Remember, this is your relative strength index. It's going to measure the relative strength of whatever it is that you're looking at its given prices. And we initially started a strong rally off of the bullish divergence here, highlighted by these circles, where we had a low and then a lower low, right? But here we had a low and a higher low. That is a simple term known as bullish divergence. You combine that also with a double bottom indicated by this arrow and this arrow. So we had a double bottom plus bullish divergence. That's about 2 buy signals right there. Then we had the MACD crossover. That's about 3 buy signals. And these 3 candles right here is a bullish chart pattern known as an abandoned baby pattern. That's actually the setup that we got on the SPY daily time frame. We're here recently and we saw a massive move up over 1% today. All right, and you can see that that led to a really, really big rally. And here we did have a double bottom, okay, indicated by these 2 arrows, and we saw a nice move up. Now, one thing that I do want to, essentially shout out, okay, is we filled half of this gap. So there's all these blue boxes on the chart right here. These are known as gaps on the daily chart, and these gaps, they fill about 90% of the time historically. The big question is when they're going to fill, not if they're going to fill. And today we did see a nice bounce for TLT off of the gap, off of the half gap. And usually if you only fill half of a gap, that's normally a bullish signal, right? So if we end up staying above this half of the gap and heading upwards, that's going to be, a bullish signal right here. Now, is it just a dead cat bounce and we're going to come back down and fill the rest of the gap just below 100? That's definitely a possibility. And, if we really want to continue heading lower on the larger weekly bear pennant that we had there, we do have this gap all the way down to $95 on the daily time frame that we could end up filling on TLT, which honestly is somewhere that I'm kind of targeting right now. I don't have any positions on TLT at the time of this recording, right? But that's definitely something I'm paying attention to. Is we've been really squeezing, as I mentioned, since December. And if you take a look, really since about October, is when we've been in this range here and just been compressing. Price action's been compressing, and we finally got to break down. If we get something known as a look below and fail, that's actually going to be a pretty bullish signal for TLT, right? So we come down, we look below and fail, right? So bears fail to take control and really, take advantage of the opportunity, and they fail. And we actually come back in the range of this trend line here. That's going to be a bullish signal for TLT, essentially because it shows that buyers and bulls are the ones actually in control, because when given the opportunity for a breakdown and retest, bears did not take advantage, and rather the bulls were in control. So You know, you can wait for, you know, things to be a little bit clearer on the picture. I mentioned that bullish divergence. All right, if you take a look here, we finally broke that bullish divergence trend line. That was a big trend line that we were looking at. We bounced off of there 1, 2, 3, 4, 5, and then the sixth time, ultimately, we broke through there. As you guys can see, we broke through there and had a strong move to the downside. Okay. So, you know, that's really everything I'm looking at on TLT. Now, as I mentioned, you know, I am really interested in bonds, right? And if you take a look after the Fed's final policy rate hike, bonds tend to reward. And if you look at the average total return after the Fed's final rate hike, okay, municipal bonds, all right, are up here at 32%. Investment grade bonds are at 27%. And then 3-month T-bills are at 13%. And this is, you know, the amount of months from the final hike, right? And so if you take a look at this is about 24 months out in time right here, these returns, these are nice returns, right? And especially if you're, you know, trading options or anything like that, you know, it can be really, really profitable. Now, these are just the returns on the bonds themselves. All right. So, you know, just keep that in mind. All right. So I'm really interested. We don't know when the Fed's final rate hike is going to be. Okay. There's a lot of debate that, you know, they already did their final rate hike. There's even more debate that they're going to continue doing rate hikes. We can't predict the future. We can just react to the present data that we have. Right. Now, let's move on a little bit more and let's talk about the island bottom reversal. That is what this pattern is right here. So if you take a look at your island bottom reversal, you have the gap down and then you have these candles here. Right, we had the gap down on SPY, okay, and then we ended up gapping up, right? You see the gaps in between these candlesticks, right, and the gaps in between these candlesticks. So we gapped down, we formed the island here, and then we got the island bottom reversal, okay, and we ended up having a really bullish day in the SPY. This is the SPY abandoned baby time frame, or SPY abandoned baby on the daily time frame, right? So we gapped down, right? We formed the abandoned baby here. Okay, and then you see we have the move up right afterwards. All right, and we ended up getting a strong candle today that looks something like this. Really, really nice to see. And if this is going to be a ABC structure, right, we could potentially see anywhere from 423 all the way up to 433 on SPY, you know, within the next week or two, right? It's very possible. I know a lot of people, you know, may not think so, but, you know, especially with AI right now, AI is like the one thing that can really drive us out of the recession, right? And, you know, that's something that a lot of people aren't considering. I know there's lots of reasons to be bearish. We have inverted yield curves. There's many things to be bearish about, but let's ask ourselves the question, what could cause the market to push higher than expected in the coming weeks and months? Well, it's going to be defensive positioning, right? And I've showed this chart before. Sorry, it's a little bit blurry. The quality is kind of bad, but when you take a look, okay, this is where investors are overweight, which is OW, and then underweight. All right. And so overweight is going to be over here. And you can see that they're very overweight in bonds, staples, cash, and utilities. And meanwhile, US equities, okay, are actually very underweight. So, you know, we've really been rallying this whole time, and you know, many investors have still been underweight in equities and had a lot of their money in cash, staples, utilities, and bonds. Okay, even the healthcare sector. So you know, there's a big chance that, you know, a lot of this money is going to be pulled out of, you know, things like bonds and cash and going to start going back into tech and start rotating into it, right? If they've been underweight all of those things and they're starting to FOMO into things now as they're rallying so much, or even if we pull back and all of their money goes from being underweight and now they're deploying it back into the market, into the equity market, that's how we can really see the market continue to go higher and push higher in the coming weeks and months. All right. You remember I said we're going to take a look. How often is the stock market positive, right? And on a 20-year time period, okay, from 1926 to 2021, rolling monthly returns, it's been positive 100% of the time. In 15 years, it's been positive 99% of the time. In 10 years, it's been positive 95% of the time. Same thing in 7 years. And once you get to 5 years and below, it's a little less frequent, but you even here on a monthly basis, 63% of the time, the stock market is positive. On a 1-year basis, 75% of the time it's positive. On a 3-year basis, it's 84%. And on 5-year, it's 88%. So, you know, we had a really, really tough market last year in 2022. And a lot of people are forgetting that the stock market is generally positive, right? It's got a 75% chance of being positive historically on a year basis, on a 1-year basis, right? So that's about 3/4 of the time, okay? And, you know, we had a really strong past 3 years. And 2022 was a rough year, and there is statistically speaking, that 75% chance that 2023 is actually going to be a good positive year for the market. Right. If we take a look here, we take a look at the percentage of time that stocks are up from 1970 to 2023. We look at the S&P 500 on a monthly basis, it's 63%. 1 year, it's 80%. 5 years, it's 90%. 10 years, it's 95%. And 15 to 20 years, the stock market is positive 100% of the time since 1970. And then you can take a look at some of the stocks excluding the US, right? The world ex-US. And we can see that those are also green as well, from the monthly all the way about to the 20-year time frame. And if you look at the America versus the world with the total returns from 1970 to 2023, all right, in the 1970 to 1978, the world ex-US outperformed the market. The S&P 500 performed at 49%, negative 49%. Or just this is just 49%, sorry, but world ex-US was the winner. That's why this one's green. 1979 to 1984, we can see the world ex-US was at 74%. The S&P was at 135%. 1985 to 1988, 299% for world ex-US. S&P at 92%. Then 1989 to 1999, the S&P was up 600%. 2000 to 2007, the S&P was up 14%. 2008 to 2021, it was up 336%. And 2022 to 2023, it's down 10%. So, when you look at these time periods and you see that the S&P 500 is mostly positive within these ranges, whether it's a 3-year range or, a 5-year range, even up to like 10 or 7-year ranges, the S&P 500 is positive about 90 to 95% of the time above a 5-year time period, and 80% above a 80% of the time it's positive within a 1-year time period. So a lot of people are just so confused. How can things possibly be going up right now? You have to remember there was a lot that was being priced in 2022, right? They were pricing in a lot of the fears that we're having for this year and a lot of the things that we're seeing happen this year. And now there's lots of talks of the recession maybe not even happening. When it comes to the labor market and the job market, we can see that those things are really holding up very strongly. And there's not going to be a real true recession unless a lot of people are losing their jobs, right? And that's just something we're not seeing. Now one thing that's really interesting, okay, and it kind of goes to the underweight section, okay, is if you look at the cumulative capital flow to equities, right here, we're seeing a huge amount, and this is institutions, right? So this dark blue line right here is the institutions. This light blue, just more regular blue line is the individuals. And you can see it's actually negative, right? So it's been negative, and institutions have actually been, withdrawing funds, right? Rather than inflows, we're seeing outflows to equities from institutions. And so there's going to be a lot of catching up to do if we end up don't getting that recession, right? If we end up not getting the recession or things aren't as bad, there's going to be a lot of catching up to do from an institutional standpoint. And that's going to be a lot of money that's going to have to be reinvested into the market. Now, the big question is, where is this money going to, right? How can the stock market, not really be down terribly? And if we look, even since 2023 has started, we're still seeing outflow from an institutional basis. Where is this money going to? Well, it's going to total money market funds, okay? And we can take a look at their assets here. It's completely skyrocketed, guys, completely skyrocketed ever since the Fed started raising rates at a, really tremendous pace. All right. And we're seeing it at some very historic levels when you look at the total money market fund assets. So, that's where a lot of this institutional and a lot of this individual money is coming from. Now, when you look at the hedge funds have been increasing their capital flow to equities since the beginning of the year, right? Since 2023 has started, it's actually up. And you look at the index/ETF capital flow, that is also, I wouldn't necessarily say it's up. It's a little bit flat. Okay, but it's not down, right? So, we're really seeing institutions and individuals are the ones who are, less bullish and not really putting a lot of inflows into equities versus hedge funds and index funds. And, a lot of that money, as I mentioned, is being put over here into total money market fund assets. Now, this is the forward PE ratio for the S&P 500. All right, if you look at the Shiller PE ratio, All right. It was at 29.39x at the time of this graph. All right, the 25-year average is at 27.86. All right, so we are slightly overvalued on the on the CAPE ratio, the Shiller's PE. If we take a look at here at forward PE, all right, it's at 18.22. All right, and the 25-year average at 16.8. One thing that I do like to mention is that a lot of times fundamental analysis can keep you bearish for too long, right? Some things may have a higher price to earnings ratio or a higher peg ratio or different things like that. And one thing is that things are constantly evolving, right? So a fair PE ratio or a price to sales ratio or something like that back in the 1920s and the 1930s isn't the same as something now in the late 2020s, right? Times have adjusted, markets have adjusted and come up with new valuations of what's a fair price for companies. And with AI right now, which I truly believe that AI is the next bubble, but that bubble is still forming, guys. That bubble really started only about 6-7 months ago. I don't know how long it's going to continue, but they have no idea how to value AI and really, how much AI is going to really benefit the world. They could be overvaluing things, they could be undervaluing things. And so a lot of times what happens is investors, both institutional, hedge fund, and retail, they will plow into anything because they don't want to miss out on the chance that they're going to miss the next big stock, right? And we're seeing that is clearly evident with Nvidia, right? They're the leader when it comes to AI chips. And anybody related to AI is really just going to be having to hit up Nvidia. They're essentially, like comparing it to the gold rush. Okay, they are essentially selling the pickaxes and rather than out there mining for the gold, and AI would be the gold in this case, right? So there is the chance that AI could actually pull us out of the bear market as well, just because of the hype and everything surrounding AI right now. And that could bring the S&P 500 up, right? The QQQ, the NASDAQ is already seeing 52-week highs, right? I think the past 14 out of the 14 times, I wish I had the graph or the chart for you guys, but the past 14 out of 14 times that the NASDAQ has made 52-week highs, ultimately it has not led to a bear market afterwards, right? It's continued the trend and continue heading upwards. Now this right here is the target rate probabilities. As we can see, as I mentioned earlier, the probability for a rate hike is increasing a lot from where it was, a while ago. Okay. If we look 1 month ago, it was only at an 8% chance that they were actually going to raise the prices or the rates up another rate hike. But now we're seeing that at a whopping 40%. So almost a 500% increase when you take a look at it. That a 5x increase, essentially is what we've seen in the chances. Now, that doesn't have to mean that the bear market has to happen, right? And just because even if we do get another Fed rate hike, I really don't think that we have to see this massive bear market, right? I mean, it definitely could happen. We could get some new black swan events and things like that. But I really think that the market is going to be adjusting to a new age of higher inflation, higher interest rates, and we can still see stock markets move forward, right? There's different cycles, there's different ages in the markets. And so, gone is the age and the cycle of, easy money, 0% interest rates, and inflation. Now what we're going to see is we're going to see high inflation, high interest rates, but still a strong economy, still a strong labor market. And we're just going to keep those interest rates for higher, just to help really keep an eye on inflation and keep inflation tamed and under control versus, cutting the interest rates when the economy is doing fine with the interest rates as high as they are. I know we've had these bank collapses. Okay. But in the eyes of Jerome Powell and many other people, they're perfectly fine with small regional banks collapsing. Okay. They don't mind that. Jerome Powell even mentioned how when he first got into, his positions in the government and things like that, there was many more banks than what there is now currently, and he doesn't really see any problem with that. A lot of people don't. One of the big fears right now is the debt ceiling. Okay. And there is a lot of talk over that. And if we default, then we definitely could see another drop anywhere from like 20 to 45% in the stock market. You can definitely believe that if the US defaults. But I really don't think that we're going to default. I think that it's just a big game of charades. Now, what are some of the reasons that I think we can see higher rates for longer? Okay, is when you look at total the financial conditions, which what we have here is the adjusted national financial conditions index in orange. We have the national financial conditions index here in blue, and then we have the S&P 500 here. All right, and what we can see is from Jerome Powell's famous Jackson Hole speech in summer of 2022, the Fed has actually increased rates over 300 basis points, right? And when you see these national financial conditions indexes rising, that means financial conditions are tightening. Look at where we're at right now, guys. Financial conditions are actually looser than what they were when the Fed increased rates over 300 basis points ago. So, when it comes to, tightening financial conditions, we're not really actually seeing tighter financial conditions. And, we're still seeing, inflation staying relatively sticky, right? If we look at the core sticky inflation versus the Fed funds rate right here, we have the Fed funds rate in orange, we have the core sticky inflation here in blue. All right. And each time that the Fed funds rate has actually started to go down and been cut or been paused, what we see is it's above the blue line, which remember, that's core sticky inflation, right? Over here, we see a pause and then a cut, and that's because it's above core sticky inflation, right? Same thing over here. We start to see rates go down a little bit and we're above core sticky inflation. Same thing over here. We're up above core sticky inflation. That's when we start to see the rates go down. And that's really been the case many times throughout history is, when the Fed funds rate is above the core sticky inflation, that's when we really start to see the pauses and the rate cuts. And if you take a look, core sticky inflation is still really high, and it's only just now started to come down, right? It really hasn't even indicated a strong downtrend. It's really almost, you could say, just leveling out, right? If we look, it had this little dip right here and then skyrocketed back up. And what the Fed doesn't want to happen is this right here again, right? They don't want to see just a temporary dip and then to see it, continue to go back up. So I think that, they could even raise, rates again, maybe even one or two more times before a pause. And I don't think it would be the end of the world, honestly, right? I think that, markets would have to readjust a little bit and, potentially reprice in further rate hikes, but they're already starting to do that, right? We looked at the data and we looked at the odds, and the market went from an 8% chance of a rate hike at the next meeting to a 40% chance. So, a lot of this stuff is already starting to get priced into the markets, even now currently. All right. So, that pretty much wraps up today's video. Hopefully you guys learned something new. All right. We went over a lot of chart patterns. We went over these chart patterns in the Discord, right? If you take a look at the Tycoon analysis, okay. I posted these patterns for you guys real late last night, like at 11:30 last night. We had the abandoned baby pattern here, then we had the bullish island reversal, and then I posted some descriptions of the charts here for you guys to see, and you can see that we really capitalized on that in the Discord. 100% here on SPX today. I mean, pretty much everybody had at least 100% on a play. This is 23% on the whole account today. Right here, this guy has been absolutely crushing it here lately in the Discord. 700% play on Adobe. Adobe was essentially a sympathy play for the Nvidia earnings play. All right, because they had a partnership with AI and Photoshop. Tesla right here, 147%. These are all call outs in the Discord. Okay, SPX plus 118%. Up 225% on SPY, SPY. We're still seeing, 42% of the account in one day right here. We're looking at NVIDIA plays, right? We did play NVIDIA in the Discord, right? 1,900% gains over here. NVIDIA 2,200% gains. NVIDIA 2,653% gains. I mean, just, we've been absolutely crushing it in the Discord, guys. Tesla 56%. If you guys are interested in joining the Discord, there will be a link in the description. Coupon code Zachly, that's all lowercase ZACHLY. That will get you a little discount on your membership if you guys are interested in joining.